there, it's Friday the 1st of February 2019. I'm Steve Towers. Welcome to ITB, coming to you a few days before Chinese New Year from Shanghai. Let's get started. Well, we do live in interesting times. As I'm sure you know by now, the policy note issued by the Inclusive Framework members this week describes a process which could change the world's international tax rules more radically than the BEPS project has done. To fully understand the initiative, you have to look at three sets of materials: the policy note itself, the OECD's press release, and the OECD's Tax Talks webcast, which was presented on Tuesday this week. Or alternatively, just sit back and listen to me. The Inclusive Framework has agreed to study 4 proposals, which have been arranged in 2 so-called pillars. The first pillar contains 3 proposals, which deal with a possible expansion of the current rules concerning nexus and profit allocation. According to the policy note, these 3 proposals would allocate more taxing rights to market or user jurisdictions in situations where value is created by a business activity through participation in the user or market jurisdiction that is not recognised in the current framework for allocating profits. And the second pillar, which relates to remaining BEPS issues, contains 1 proposal. Before I take you through the 4 proposals, let me just say that none of them is new. Folks have been discussing them for several months, including me in ITB. The first proposal in Pillar 1 focuses on user contribution. Yes, this is the proposal which the UK has been advocating. It would require that the existing profit allocation and nexus rules be revised by reference to the amount of active user contribution in a jurisdiction. This proposal would be limited to highly digitalised businesses, where value is created by user contributions, for example, social media and search engine services. The second proposal in Pillar 1 focuses on marketing intangibles. This is the proposal which the US is advocating. And I think that China might support this proposal as well, although I don't believe that there's been any public statement to that effect. This proposal would require that the existing profit allocation and nexus rules be revised by reference to marketing intangibles. It would recognise the value created by the marketing jurisdiction. This proposal would apply broadly to all types of businesses. And the third proposal in Pillar 1 involves the concept of a significant economic presence. This would create a new nexus rule. This proposal was included in the BEPS report on Action 1 in 2015. India is currently implementing this proposal, although only in its domestic law. There's no treaty element yet. The OECD has said that India and Colombia are advocates for this proposal. It's also supported by many other developing countries because it is seen to be the easiest proposal to administer. In Pillar 2, the only proposal is the German-French Global Minimum Tax proposal. This proposal seeks to address ongoing profit shifting that arises due to significant disparities in tax rates. For example, under the current BEPS rules, it is possible for profits to be correctly recognised in a no or very low tax jurisdiction if there is significant economic substance in that jurisdiction. This global minimum tax proposal will enable the residence country of a related party investor and the source country to tax back, that's the OECD's expression, those profits. And so this proposal would contain an income inclusion rule, which would include the profits in the taxable income of a related party investor, for example, the ultimate parent company. There would also be a source country tax on outbound under-taxed base eroding payments. This could take the form of a denial of deduction for such payments or the imposition of a withholding tax, and a coordination rule to avoid double taxation. According to the policy note, the Inclusive Framework members have agreed to examine the 4 proposals with the objective of reaching a consensus. If you were in any doubt, the proposals go beyond the arm's length principle. The proposals should be designed so that they do not result in taxation when there is no economic profit, and they do not result in double taxation. And the policy note stresses the importance of tax certainty and effective dispute prevention and dispute resolution tools. The materials set out the next steps through to June 2019. In February, the OECD will release a public consultation document. On the 13th and 14th of March, a public consultation meeting will be held in Paris. Before May, the Inclusive Frameworks Steering Group will prepare a detailed program of work. At its May meeting, the Inclusive Framework will discuss and hopefully agree that detailed program of work. And in June, progress would be reported to the G20 finance ministers. And the ultimate objective, in the words of the policy note, is to deliver the solution in 2020. For a copy of the policy note and the OECD's press release, and to watch a replay of the OECD's Tax Talks webcast, please go to our website. The OECD has released the 2018 Progress Report on the review of preferential regimes under BEPS Action 5. Since the start of the BEPS project, the Forum on Harmful Tax Practices has reviewed 255 regimes from 70 jurisdictions. Here's the overall summary. Let me mention some of the key numbers. 63 regimes have been abolished. 14 regimes are in the process of being eliminated or amended. 47 regimes have been amended to become not harmful, and 4 regimes have been amended to become out of scope. That's a total of 128 regimes which have been impacted by the reviews. As you can see, there are 28 regimes which are currently under review. Amongst those 28 is the US FDII regime, which is listed as both an IP regime and a miscellaneous regime. Included in the report is a discussion of the current focus on NOON jurisdictions, no or only nominal tax jurisdictions. For a copy of the report, please go to our website. The OECD presented its latest Tax Talks webcast this week. The highlight, of course, was the Inclusive Frameworks policy note on digital taxation. There was also discussion of the progress report on the review of preferential tax regimes, which I've just covered, Action 6 peer review, a report will be issued in February, the MLI, CBC Reporting, and MAP under BEPS Action 14. To watch a replay of the webcast, please go to our website. Let me do a survey of some recent interesting transfer pricing cases from India. Let's start with a quick recap. I'm sure you know that we've had this long line of cases in India concerning advertising, marketing, and promotion expenditure, extending over many years. An early and influential case was the LG case in 2013. In that case, a special bench of the Income Tax Appellate Tribunal accepted the argument of the tax authorities in regard to the so-called bright line test. Under that test, if an Indian distributor of branded goods, which are purchased from non-resident related parties, incurs an excessive amount of AMP expenditure which is not reimbursed, then the excessive amount is considered to be incurred as a service for the non-resident trademark owner, and thus an arm's length consideration equal to the excessive amount plus a markup is imputed under the Indian transfer pricing rules. You determine whether the AMP expenditure is excessive by comparing the Indian company's percentage of AMP expenditure to sales versus the average percentage of a set of comparable companies. Many of the cases involved Indian distribution companies. However, in some cases, the bright line test was applied to Indian manufacturing companies which manufactured goods on which the trademark was placed. A significant watershed in this line of cases occurred in 2015. In that year, the Delhi High Court decided two significant cases which rejected the bright line test. The first case was Sony Ericsson Mobile Communications. In this case, the court said that the AMP expenditure in this distributor situation should not be considered in isolation. Instead, it should be bundled together with the goods purchase transaction. The profitability of the distributor then needs to be determined on this bundled basis by benchmarking against comparable companies. And the second case was Maruti Suzuki. In this case, the court said that the existence of an international transaction cannot be presumed by the tax authorities, merely because the bright line test indicates that an excessive amount of AMP expenditure has been incurred. Instead, said the court, before the tax authorities can apply India's transfer pricing rules, they must first establish, based on the facts, that there is an international transaction, formal or informal, between the Indian company and the non-resident related party in regard to the AMP expenditure. These two cases are on appeal to the Supreme Court, which will presumably have the final word on the bright line test and excessive AMP expenditure. But in the meantime, the income tax appellate tribunals continue to decide cases on this topic. In the last month or so, the Delhi Income Tax Appellate Tribunal has decided several cases on this topic. Let me quickly run through three of them: Sony, LG, and PepsiCo. First, the Sony case. And let me just say that this case concerns a different taxpayer and different scenario from the 2015 Delhi High Court case, Sony Ericsson Mobile Communications. The Indian company is the distributor of Sony goods, which are purchased from non-resident related parties. The Indian company was granted a royalty-free license to use the trademark, and it incurred AMP expenditure. There's an inference in the tribunal's decision that there was no formal agreement that the AMP expenditure would be incurred by the Indian company on behalf of the non-resident trademark owner. A critical fact was that the Indian company's profitability under the TNMM method, using operating margin as a percentage of sales, was higher than the average of the comparable set. The tribunal said this: since the operating profit margin of the Indian company is better than those of the comparables, it can be safely concluded that the Indian company has been suitably remunerated and no further adjustment is required to benchmark the AMP expenses. Now let's look at the LG case. The Indian company is a manufacturer and distributor of branded goods. It incurred AMP expenditure, which was considered excessive by the tax authorities on application of the Bright Line test. The tribunal decided in favour of the Indian company for two reasons, each flowing from the two Delhi High Court cases in 2015. Firstly, there was no evidence to support the existence of an international transaction in regard to the AMP expenditure. And secondly, the Indian company's profitability was higher than the average of the comparable set. The tribunal said this: considering the facts of the case in hand in totality, we are of the view that the revenue has failed to demonstrate by bringing tangible material evidence on record to show that an international transaction does exist so far as AMP expenditure is concerned. Therefore, we hold that the incurring of expenditure in question does not give rise to any international transaction as per judicial discussion hereinbefore. And without prejudice to these findings, since the operating margins of the assessee are in excess of the selected comparable companies, no adjustment is warranted. The third recent case is PepsiCo. The Indian company is a manufacturer and distributor of goods. It was granted a royalty-free license from the US parent company, covering the various patents and trademarks in regard to the goods. The Indian company incurred AMP expenditure, which was considered excessive by the tax authorities on application of the Bright Line test. If all this sounds a little familiar, yes, these cases have a lot of similarities. But there are a number of important aspects in this case. Firstly, in regard to the issue of whether there is an international transaction in regard to AMP expenditure, the tax authorities pointed to the fact that under the license agreement, the parent company was given the power to approve proposed advertisements in India. They also pointed to the fact that the Indian company made some payments to the parent company in regard to worldwide sponsorship rights. Both of these facts indicate, according to the tax authorities, that the Indian company and the parent company were acting in concert in regard to the AMP expenditure, and the Indian transfer pricing rules would deem that to be an international transaction. The tribunal disagreed. In regard to the approval of advertisements, the tribunal said that this is merely to ensure brand consistency. It is not evidence of acting in concert in regard to the AMP expenditure. And in regard to the worldwide sponsorship rights, this was merely a cost-sharing arrangement in which the Indian company was not required to participate. The tax authorities also pointed to the significant amount of AMP expenditure which was incurred by the Indian company, and which would benefit, according to the tax authorities, the parent company as the owner of the trademarks. Again, the tribunal disagreed. It said that the AMP expenditure incurred in India will benefit only the Indian company. For a copy of these 3 recent cases, please go to our website. I have one case concerning finance transactions. It's called Glenmark Pharmaceuticals. It's a decision of the Supreme Court and it concerns corporate guarantee fees. Although the decision is short, it is significant. The Supreme Court approved the earlier decisions of the Income Tax Appellate Tribunal and the Bombay High Court in this case. And those decisions were that an arm's-length corporate guarantee fee, for example, a parent company guarantees a loan borrowed by a subsidiary, cannot be directly determined by a quoted bank guarantee fee, a fee which is quoted by a bank for providing a guarantee. In this case, the tribunal had accepted the 2 corporate guarantee fees which had been charged by the taxpayer. These were set at 0.53% and 1.47% and had rejected the use of a quoted bank guarantee fee of 3%. In Australia, the full federal court has decided a CFC case against BHP Billiton. As you might know, BHP Billiton has a so-called dual-listed company structure. The structure includes 2 listed public companies, BHP Billiton Limited, which is an Australian company, and BHP Billiton plc, which is a UK company. Each of those 2 listed public companies, which I'll call Limited and PLC, has its own shareholders and its own subsidiaries and investments. However, there is a DLC structure sharing agreement between Limited and PLC, which requires them to operate as if they were a single unified economic entity through common boards of directors and a unified senior executive management. The case focuses on a company called BMAG, BHP Billiton Marketing AG, a Swiss company. During the relevant years, BMAG was 58% indirectly owned by Limited and 42% indirectly owned by PLC. BMAG was a central marketing entity for the DLC structure. Its profits were substantially derived from buying and selling goods between the DLC structure and third parties. Under Australia's CFC rules, BMAG was a CFC in respect of Limited due to the 58% indirect ownership interest. So the issue in the case was not whether BMAG was a CFC or not for Australian tax purposes. It definitely was. The issue was in regard to which particular transactions entered into by BMAG are taken into account under Australia's CFC rules, or to use the technical expression, which of BMAG's transactions give rise to tainted sales income. And for that purpose, it had to be determined whether PLC's Australian subsidiaries were associates of BMAG, which is a defined term. Now, I won't take you through all of the definitions, but the critical definition was of the phrase sufficiently influenced. Under that definition, ACO is sufficiently influenced by BCo if ACO or its directors are accustomed or under an obligation, whether formal or informal, or might reasonably be expected to act in accordance with the directions, instructions, or wishes of BCo. The majority in the court emphasised that this definition of sufficiently influenced requires something less than legal control, and based on the single unified economic entity and other requirements in the DLC structure sharing agreement, the majority held that Limited was sufficiently influenced by PLC, PLC was sufficiently influenced by Limited, and BMAG was sufficiently influenced by Limited and PLC. And each of those items was sufficient, please excuse the pun, for the case to be decided against the taxpayer. Let me share with you two interesting extracts, both from the judgment of Justice Thorley, who was one of the two majority judges. Here's the first. The fact that Limited and PLC both have influence or control under the DLC arrangement on a day-to-day basis and may be seen to be joint venturers in relation to substantially all of their commercial affairs does not alter, and if anything, underscores the fact that the relationship is one of which it is appropriate to say that one is sufficiently influenced by the other. At least in the circumstances of this case, it is no objection to the application of the sufficiently influenced definition that the sufficient influence or control might be seen to go both or different ways depending on the particular occasion or subject matter, which suggests that joint venture and other collaboration arrangements might also cause the sufficiently influenced definition to be satisfied. The second extract concerns the position of the directors of BMAG. Were they sufficiently influenced by Limited and PLC? Justice Thorley said this: whilst subservience or abdication of responsibility would likely be sufficient to satisfy the sufficiently influenced definition, neither is necessary. The fact that directors fulfill their duties to their company and only agree to a direction if to do so is found to be in the interests of the company does not necessarily prevent the conclusion that the sufficiently influenced definition is satisfied. Let me put that another way. The directors can, at the same time, exercise central management and control and also be sufficiently influenced. For a copy of this case, please go to our website. In China, the government has released Circular 8 of 2019, which deals with the individual income tax liability of venture capitalists. You might recall that in September 2018, a senior SAT official put the cat amongst the pigeons by stating that the long-term practice of levying a flat 20% income tax on venture capitalists is illegal, and it would be replaced by the regular progressive rate scale from 0 to 35% retrospectively. After a period of unusual public criticism of this change by, amongst others, the People's Daily, a government-controlled newspaper, the government announced that there would effectively be no change to the long-standing practice. Well, Circular 8 reflects this announcement. Under Circular 8, a venture capital enterprise will have a choice as to the individual income tax method which will apply to the venture capitalists who are partners in the enterprise. Either the flat 20% rate if the venture capital enterprise calculates its profits and losses on the basis of each investment fund separately, or the progressive rate scale from 0 to 35% if the venture capital enterprise calculates its total annual profits and losses on an aggregated basis. If a method is chosen, that method can't be changed for 3 years. If no method is chosen, the default is the progressive rate scale from 0 to 35%. For a copy of Circular 8, please go to our website. In Singapore, the tax authorities have issued updated guidance on the income tax exemption for foreign-sourced income. For a copy of the updated guidance, please go to our website. In Austria, it's been reported that online marketplaces will be given VAT reporting responsibilities in regard to vendors on their platforms, possibly effective as early as the 1st of January 2020. You'll remember that in December, the European Commission announced that it had decided that Gibraltar's corporate tax regime for interest and royalties between 2011 and 2013, and 5 specific tax rulings constituted illegal EU state aid. I covered this story in ITB on the 21st of December. Well, the Commission has now released the non-confidential version of the reasoned decision on this matter. For a copy of this document, please go to our website. In its January infringements package, the European Commission has announced that it has referred 3 tax matters to the European Court of Justice. Such a referral is the 3rd stage of a dispute between the Commission and a member state. The 3 tax matters are these: a referral of Germany for its failure to align with EU rules on VAT refunds, a referral of the UK for its failure to comply with VAT rules for certain commodity markets, and a referral of Italy for its preferential treatment of property registration tax. For the Commission's press releases on these 3 referrals, please go to our website. In Poland, the 1st of July 2019 has been set as the amended start date for a mandatory VAT split payment system for a small range of B2B transactions, which have been subject to missing trader VAT fraud in the past. Under the proposed Polish VAT split payment system, the customer must deposit the VAT portion of an invoice directly into a special bank account of the supplier, which is monitored and controlled by the tax authorities. In Russia, you might remember that effective the 1st of January 2019, foreign suppliers of inbound B2B online services must register and comply with the Russian VAT law. Previously, a form of reverse charge applied to such transactions. Requiring registration and compliance in such B2B situations is relatively unusual amongst VAT systems. Well, if you're one of these foreign suppliers, you have until the 15th of February to submit an application for VAT registration. In Kenya, the High Court has decided a case in regard to the VAT zero rating of exported services. The particular services were performed in Kenya by a Kenyan air freight handling company. The services were the scanning, cooling, and palletizing of Kenyan horticultural products prior to their export to Europe. The services were performed for a Netherlands company with no establishment in Kenya. For many years, the tax authorities had taken the view that for VAT purposes, services are supplied where they are performed. The High Court rejected this position. It held that the Kenyan VAT law requires the destination principle to be used. The services were therefore supplied outside Kenya, and thus they were zero rated for VAT purposes. In Nigeria, the government has launched a new tax incentive program for the construction of roads in the country. The tax incentive program involves the provision of tax credits equal to the full cost of the construction project plus a small uplift. The tax credits will be issued each year to participants based on construction milestones achieved during that year. The credits will be available to offset the participants' corporate income tax liabilities, and they can be sold to other companies for their utilisation. Also in Nigeria, it's been reported that the government will raise the VAT rate from 5% to 8% later this year, although it's currently unclear whether the 8% rate will be the new standard rate or whether it will be limited to certain luxury goods. It's been reported that Brazil's economy minister has outlined a major reform of corporate tax rates at a closed-door lunch meeting in Davos last week. According to one report, the current corporate income tax rate of 34% would be slashed to 20%. In fact, another report said 15%. But as the quid pro quo, a dividend withholding tax of 20% would be introduced. Dividends are currently tax exempt. And in the US, the government has scheduled public hearings on proposed regulations for GILTI and opportunity zones. In regard to GILTI, I'm sure that a major topic will be the scope of the anti-abuse rules. And now for this week's treaty developments. We've had one protocol signed and 2 treaties enter into force. Well, that's the way it is this Friday, the 1st of February 2019. The ITB team will be having a well-earned 1-week break. We'll be back full of life on Friday, the 15th of February. Until then, I'm Steve Towers, wishing you all a very healthy and a very wealthy Year of the Pig. Gong Xi Fa Chai. And of course, have a great weekend.